Hello, welcome back to this session of engaging session of concept of money market and its instruments. So again, I am Dr. Priyank Sharma, Assistant Professor, Swami Rama Himalayan University, School of Management Studies. So today we are going to explore a critical component of financial system that often operates silently in the background yet holds immense importance, the money market. Okay. So let's begin by understanding what exactly the money market is and what it actually do. So the money market is a segment of the financial market where short term debt instruments, that is instrument with maturities of less than 1 year are traded. Think of it as the marketplace of highly and liquid low risk financial assets, some things or sometimes referred to as a cash equivalents. So these instruments are essentially financial lifeblood for government, corporations and financial institutions needing to manage their short term funding needs. So as we talk about the US, in the US alone, the money market presents a staggering $6 trillion in outreaching instruments. That tells you how large and vital this segment is. Now, let's take a closer look at the functions of this particular, that is known as money market, or what are the functions this money market serves as. So, first and foremost, it provides liquidity. Businesses, liquidity to whom? Liquidity to businesses, government, institutions, financial, and often need short term fundings, whether to bridge a cash flow gap, finance inventories, or simply park surplus funds. The money market is place where they go. Okay. So second, it enables the efficient cash management. And it's say a company, let's say a company has idle funds, it won't need for the next 2 months. So instead of letting that cash as idle, the company can invest it in a money market instrument, earn some interest and remove it when it needed. Thirdly, we can say that it acts as a benchmark for interest rates also. The rates offered on instruments in the money market influences the rate in the money market, or its rates are charged by the banks and other financial institutions across the board. And finally, the money markets acts as a source of short term finance. Corporations issue instruments like commercial papers, and government float treasury bills to raise money quickly and efficiently. Now that we can understand the structure and purpose of the money market. So let's turn our focus to the various instruments that constitutes the money market. As we know that the money market is a short term market. So let's have some instruments that constitutes the money markets, and begins with the well known structure or well known products that is known as treasury bills, or it is commonly known as T-bills. T-bills are short term debt instruments actually, that is issued by the government, and their maturity can be short as a few days or go up to 52 weeks, that is for 1 year actually. One of the unique aspect of the T-bill is that they are issued at discount and redeemed at face value. That means they are issued at a discounted value and can be redeemed at the face value. The difference between the issue price and the face value becomes your effective yield or the return. Let's have an example. Suppose you buy a 26-week T-bill for rupees 9,800 and it matures at 10,000. So your return is 200 rupees, which annualized in approximately 4% or 4.08%. So that is what the return on this. So T-bills are actually considered risk-free because they are backed by the government, making them a popular investment choice for conservative investors. So next, the instrument that we usually talked about and we also discussed in the last one, that is commercial paper. So let's see what are these commercial papers. So actually the commercial papers are unsecured short-term debt instruments. They are unsecured and short-term debt instruments issued by large and financially sound corporations. So these are issued by the large companies and those who are financial corporations. So these instruments are primarily used to meet short-term liabilities such as payroll accounts payable or seasonal inventory requirements. Okay. CPs, that is commercial papers, typically have maturities that is ranging from day 1 to 270 days. Why 270 now? Because anything beyond that would require registration with the SEC in the US market and adds the regulatory burdens that companies prefer to avoid. Actually, the interest rate on commercial papers are negotiated between the issuer and the investor and heavily influenced by the credit rating of the issuing company. For instance, companies like Apple or Microsoft, who have a good top tier credit ratings, can issue CPs at very competitive rates. Now, let's move to the next instrument of the money market, that is known as CDs or commercial certificates of deposits, it is known as actually. So CDs are the time deposits which are issued by the bank and credit unions. They entitle the bearer to receive interest at a fixed or sometimes variable rate after a specified period. So unlike savings accounts, you cannot withdraw funds from CD before maturity without facing a penalty. So if you are going to withdraw prior to maturity, so you have to pay the penalty also. Maturities of CDs can range from few months to several years also. Though short-term CDs, that is short-term certificate deposits, especially those which are under 1 year, are what we typically encounter in the money market. Okay. These are the two notable types of CDs. Negotiable CDs, which are typically issued in large denominations and can be traded in the secondary market also, and brokered CDs, which are sold through brokerage firms. And yes, CDs are insured by the FDICs up to $250,000 in US per depositor per insured bank, making them relatively safe investments. Okay. Now, our next instrument of money market is slightly more complex but equally important, that is repurchase agreements or repos. It is commonly known as repos. So, a repo is essentially a collateralized loan. In a repo transaction, one party sells the security to another with an agreement to repurchase it at a slightly higher price at a later date. Usually it can be a next day. Okay. These are widely used by banks and financial institutions also to manage short-term liquidity. The extra amount paid during repurchase represents that the repo rate, which is essentially the interest on the loan actually. Okay. So, repos often involve government securities as collateral, and they play a crucial role in central bank corporations. For example, the Federal Reserve uses repos to control money supply in the economy. Okay. It is also a method by which the governments can control the supply of money in the economy. There is also a thing which is known as reverse repo, which is simply the flip side of the repo, buying securities with the agreement to sell them at a later higher price. Okay, later higher price. So, moving on, let's talk about the banker's acceptance or BA. It is also a product of the money market. So, these are short term credit instruments usually used mostly in the international trades actually. So, the banker's acceptance is created by a non-financial firm and guaranteed by a bank. Let us have an example. Imagine an American importer needing to pay a Japanese exporter. The importer's bank will issue a banker's acceptance, okay, and promise to pay a certain sum at a future day. Okay. The exporter can either hold the BA until the maturity or sell it in the secondary market at a discounted prices. So, because a reputable bank guarantees the payment, so bankers' acceptance are considered low risk instruments. They are also liquid and can be traded freely before maturity. So, now we come to the final instrument, but our list that is money market mutual funds. It is in short known as MMF. So, these are actually mutual funds that invest primarily in money market instruments like T-bills, CPs, CDs and repos. So, their objective is to offer investors a safe place for invest and easily accessible cash equivalent assets. Okay. So, there are different types of money market mutual funds. For instance, government funds invest only in government backed securities. Private funds may invest in corporates or the companies or corporate debt. Okay. So, these are basically money market mutual funds are actually regulated by the SEC in US and in SEBI in the India, are known for offering liquidity, stability, although they are not entirely risk free for retail and institutional investors alike. So, money market mutual funds offer a convenient way to access the money market without directly purchasing the instruments actually. Okay. So, to conclude with what we can say, the money market plays a crucial role in the financial ecosystem by providing short term liquidity, facilitating trade and supporting the functioning of banks, government and also the corporations alike. The wide range of instruments from treasury bills, commercial papers, from certificates of deposits to bankers' acceptance allows for a diverse and efficient management of short term capital. Okay. So, the money market instruments provide the working capital requirements, and for investors both type, that is big and small investors, money market mutual funds provide a reliable avenue to park funds safely while still earning the returns. So that's a wrap up for our session on the concept of money market and its instruments. So we will also talk about some more things. Thank you for joining today. I hope it is an understandable session. Thank you.